We have a few things going in the way that we do not follow a model portfolio,
Sure.
right? I think that is very critical, especially for PMSs slash managed accounts. Uh, Everybody, I think, in their right mind would agree that you should not be following a model portfolio. If you have, say, 25 stocks in your portfolio and money is hitting your account every single day, not all 25 are buys every single day, right? You may be in the process of selling out a few. There is no point in you buying the shares today only to sell a week, a month down the line. The reason why people do it is because sort of, it's a logistical nightmare. You can't run 3 5,000 accounts on an Excel sheet.
Sure.
With varying weights. So the practical solution is, just you copy paste the portfolios, right? And that's a sort of decent
Sure.
way to do it. But then there is a better way. When we started working with an IT company. We now have a full solution in place which allows us to run and create each portfolios as we go along.
Sure.
So when we were in March, we were essentially saying that we are investing sort of entire portfolio in a week or so, because we could buy businesses which made a lot of sense from a longer term standpoint. Today, when we are receiving, a lot of our shares have also doubled in the process of the last 4 months or so. And what we are now saying is that we are taking somewhere around 3 to 4 months from how things appear today.
Sure.
To fully invest.
Sure.
And also, so one part is, timing the entry into creating a portfolio. The other clear part, and internally we manage it with core and satellite, and I think as this discussion progresses, we'll talk further.
Yeah.
But I think if you break it down from a simple large, mid cap, small cap perspective, then, I'll run you through a little bit of the history here. In Jan 2022, we were roughly around 70% in large caps and cash. We had turned defensive.
Sure.
The markets were still looking for the next multi-bagger.
Sure.
We couldn't find businesses which made a lot of sense. Obviously, we weren't aware that Russia-Ukraine conflict would transpire. At that point in time, we said, let's just hold on. Makes sense. A lot of dividend yielding names made a lot of sense. With the Russia-Ukraine conflict and the ensuing sort of mayhem, the small cap exposure, even with us, stood at a minuscule level. And we started building that until March 2023, when small caps became 50% of our entire portfolio. Now, with the rally that has transpired, we are taking time to sort of clip off a lot of those positions. As we speak, we are still somewhere around 43%. Now, that 50% in fact has outperformed by huge margin. Right? So you are cutting 20% odd positions in small caps. You still have an extremely large outperformance to contend with, and that we are taking money off as we speak. If we are investing a new portfolio, much larger size is getting into large caps rather than the 40% small cap that we have today.
Very interesting. And before I kind of delve upon further, I would like to get your thoughts on what made you start off Buoyant in the first place, and who are your other co-founders, and how is your work divided amongst all three of you?
Correct. Buoyant is owned and run by three of us: Sachin, Viral, and myself.
Sure.
Sachin Khivasara, Viral Berawala, and myself. All three of us are chartered accountants with 20 plus years in the market. So, as you gave a brief introduction before starting Buoyant Capital, I was the director of research at HSBC Bank.
Sure.
And my job was to advise all these foreign institutions, largely sovereign wealths, government of Singapore, government of Abu Dhabi, and long onlys like Capital, Fidelity, etc., on how and where to invest in India. And also, I was tracking the global metals and mining sector. Viral is a chartered accountant and alumnus of IIM Ahmedabad. He was last the chief investment officer of Nippon Life Insurance. He was, I think, covering a little over $3.5 billion into equity and debt. And Sachin is also a CA and a CWA, and was last with, Nippon Asset Management. So the genesis of Buoyant Capital was simple. That, for far too long, I think the way mutual funds were managing money, with an increase in size, there is a legitimate problem.
Yeah.
Of running strategies which are anything other than buy and hold.
Sure.
Right? Buy and hold, if you look at the equity sort of history in India, we have a fairly smallish time frame, right? Global equity investing is very rich, hundreds of years of data. In India, we have a market only for around 25, 27 years, which is effective. Now, for a vast majority of that, buy and hold as a framework work very well. So let's say if you are an investor in the year 2000, you are facing an externality which is very different from what it is right now.
Yeah.
You're facing your economy which is fairly nascent, liberalized only 8 years ago or so. Your companies are very small themselves, and foreign capital in India at the time was hardly anything, close to 15 odd billion dollars. Fast forward 20 years, as the economy grew, companies grew at an unprecedented pace.
Sure.
Right? Your IT story is very well known,
Yeah.
but look at cement, look at zinc mining,
Yeah.
look at FMCG, retail, steel. Like
Yeah.
JSW Steel grew from 1 million to 25 million tons. So on one hand, sort of capital was playing thick and hard. Companies were growing at a fairly decent click, and foreign capital was chasing it like there was no tomorrow. Right, so what was 15 billion grew to something like 600 billion by 2020. They ended up owning 22% of corporate India, 2.5 times the size of mutual fund.
Yeah.
Now, if you are an investor in this era, your job, I would sort of say it myself, is fairly simple. It's not easy. You have to still find durable growth. But if you identified a great company, that automatically became a great investment because of the sheer amount of capital chasing these good quality businesses. And that sort of we started in this era, but essentially our view was different, right? Whereas buy and hold as a framework has worked fairly well, increasingly the ingredients that led to buy and hold working are now inversing. So on one hand, you have companies not growing at the same speed, right? Obviously, you have attained a size, it's not possible for you to grow 20 times in the next 2 decades. Secondly, foreign capital is coming in, but not at the same speed, right? What was in fact 22% of India ownership is now a little over 18%.
Yeah.
And domestics are investing surely, but they are a very different breed of investors. Like FIs were largely doing it without feet on street. Comparatively, domestics have a lot more value conscious, is what we'd like to believe. And third, and more importantly, earlier the only way for a company to raise equity was to come and get listed, right? So as a public market investor, we could all participate in that growth. Today, look at say a Nykaa, Paytm, PB, Zomato, Delivery, Car Dekho. Few of them are very interesting business models, but by the time they are offered to us as public market investors, PVCs have already extracted like a 10, 15, 20 billion dollar in valuation, and they are offering it to us at 3 to 5 times the value we are hoping to run away with.
Yeah.
So essentially we saw these as two distinct eras, and we want to profess what we call investing through cycles.
Sure.
We didn't really find anybody else doing that in India. Globally, there are a lot of funds which believe in it. But in India, because buy and hold has worked for so long, so well, I think that's the common belief system of a large number of investors. And the only other part was that, see, initially all of us had done and spent a lot of time doing research, doing investing, but a very less amount of time, facing distribution.
Yeah.
So initially we said, let's start off. It would be unfair of us to, come to you on the first day and say, look, we have done this, we have a completely new idea now, make us meet your investors. So initially we, first 3 or 4 years, we put time creating a track record, ran money for families who knew us directly in a little bit of our own kitty. And now sort of we have started working with a lot of partners like Motila.
Very interesting. I mean, could you take us through a little more on the strategy itself,
Okay.
I mean, the core and satellite?
Yes. Right. So see, fundamentally, if you believe that everything operates in cycles, right,
Yeah.
and there is ample and more data on how cycles get created. So think about, say, companies.
Yeah.
Now today, let's say we are able to identify a company with a fairly long runway for growth, right? While the earnings can keep compounding at say 20% CAGR for 30 years on a consistent basis,
Yeah.
in our opinion, it is slightly naive to believe that share prices also compounds on a consistent fashion. Right, the market, having found such like a holy grail, gets so excited initially, and it starts dislocating your share prices vis-a-vis the earnings growth. So you could have a point in time when the previous X years, right, 2, 3, 5 years, the earnings would have grown at 20% CAGR, but the stock price is compounding at say 30, 40, 50% CAGR. Now that's one cycle where earnings growth has been much slower than your share price growth, but then the market realizes that you're paying too much to buy a business like this, and the stock prices flatlines, it goes down a little bit till the time earnings catch up. Right, and you'll be surprised, this earnings catch up cycle can very easily last 10 years, it can equally easily last 20 years as well.
Sure.
Right? Coca-Cola, Warren Buffett bought it in 88, till 98 a great company and a great investment, but then for the next 19 years when the earnings doubled, stock returns were essentially zero. Right? IBM from 99 to 12 years, earnings tripled, stock returns zero. Colgate in India, 15 years from 1994, earnings quadrupled, stock returns were zero. So essentially, stocks have behaved in cycles. In India, we didn't notice them before because you are in buy and hold frameworks. But now over the past 3 or 4 years, this is truly glaring us in the eye. Right? And not just at stock level, look at sector levels. 14 to 19, all you could think about is only consumption. Right? And the narrative that a lot of people built was that these companies are so strong that nothing bad could happen to them. Crude prices could inflate, commodity crude could inflate. But it's this moat around this business is so large that it's okay to pay 40, 50, 100 Ps. Right? And investors kept on buying until that cycle peaked in March 2020. And for the past 3 or 4 years, it's been a very difficult time for the proponents of most of these people, which should not have been. Have you looked at the 2000 to 2008 cycle? Right? Capital goods was the flavor. The index was up 19 times. ABB was up 24. Crompton was up 45 times. But when that cycle peaked, it took 11 years for the index to come back to the same level. Right? So what we are arguing is that you can see these cycles being omnipresent at stock level, sector level, even market cap. Right? 20 years, small cap and large cap, there's not a huge difference in CAGRs. But between December 17 and March 20, the large cap fell 12%, small cap fell 50%. Now the narrative that point in time was that, look, there are only these 20 great companies worth investing in, everything else you sort of completely ignore. The exact opposite is today, right? Today, if you tell somebody that I'll invest in large caps, they'll look you as if you have lost a marble or somewhere. So essentially, these cycles are present everywhere. The way we approach through this is that on the paper, our framework is fairly simple. We either approach the markets being aggressive, at which point the idea is to generate a superior return. When satellite, what we call satellite, is a smaller part what we call satellite is a larger part, compared to the core. And having generated superior return, we want to protect the capital. When satellite becomes a smaller part of what we do, core becomes a larger part, and the idea at that point is to protect capital, right? So between say 2016 and end of 2017, we were aggressive. Then we turned defensive, could reasonably protect capital around 2018 when a lot of small cap funds fell through the cracks. 2019 we became aggressive, slightly ahead of time, I might add myself. We became aggressive in February. The market turned around, I think September, when the finance minister came around and announced those corporate cuts. And then we stood aggressive through COVID, generated a reasonably strong return. And then we became defensive around 2021. And since then we have been, obviously, see, now the markets have had a life of its own. But even on the worst sort of ambers of those times, we were still able to protect capital, which is the end goal. So when you combine these for 7 years, we are roughly at around 22.6% CAGR post fees and expenses at the PMS number.
Impressive. I think that puts you way ahead of others in the league table.
Right. So again, so a little bit of rude for me to say it myself, but yes. More importantly, see, when you compare this with the risk frameworks, that works out reasonably well. So look at it from either rolling return standpoint or from, say, statistical risks, right? So for example, you look at the beta of our portfolio. Over a 1 year, we are at 0.93. You look at 3 years, we are at 1.1 times. So I don't think that's a dramatically higher risk to generate almost 2 times market return on a 1 or a 3 year basis. But more importantly, CRISIL now looks at PMS not just from a statistical standpoint, but also from the standpoint of how concentrated your portfolio is, how illiquid your portfolio is. And we have always managed to get their best in class risk rating, which is a 5-star rating. So very happy to that returns are reasonably decent. They are a lot more consistent and they are a lot better on a risk adjusted scale.
So when you are in a bullish mode or when you're optimistic, your satellite portion significantly moves up,
Yes.
and when the case is otherwise, it moves it down.
Correct.
So at the moment, what is the portfolio looking like?
So we are in the defensive stance today.
Sure.
Core and cash is a little closer to 63%.
Sure.
We are turning that ship as we speak because I think we are very happy with the way things have played out over the past 4 years, 4 months or so. And as I said, if the pendulum is swinging on the other hand, it is difficult for us to start building a very aggressive stance from 5.5 Fed fund target rate, 86 billion in QT, and you start bringing that to India equity markets at an all-time high. So it's been great. See, 10 years are going to be great, but I think it's better off if we don't go down the quality curve today rather than going up the quality curve. If at all, see, all of us while running money, there are mistakes that are inevitable.
Sure.
Right? We'll definitely make a lot of them. The whole idea of a time like this is to utilize them to correct a lot of those mistakes which you have made in the past cycle. Because when the tide turns, see, today it might look like there is a lot of liquidity sloshing through. You'll be able to sell the positions that you have. But when the liquidity dries out, such was the case in March 2023, right? Not a huge time ago, when you try selling, a minuscule quantity, but everybody was busy putting money into fixed deposits or buying insurance with the changes in the budget, you couldn't really sell a lot of equity if you wanted to. Now with the liquidity, businesses that you fully understand, are aware and they have not run up a lot, those are the ones that you would want to be invested in rather than trying to discount a FY27 30 times multiple with like a 300% growth from here to FY27. So that's the whole philosophy. See, doing what we do, we are never the number one on any particular cycle.
Sure.
Right? In a small cap cycle, a small cap fund will definitely do better.
Yeah.
But the best run small cap fund today was down 70% between 2018 and 2020. So the whole idea of us is to be like a top quartile performance whichever the cycle. If consumption is great, we want to be top quartile. If commodities is great, we still want to be top quartile. But when you combine these cycles, the hope is that this will propel us much higher relative to the rest of the street.
Sure. So, in the endeavor to kind of catch up with these cycles and straddle to this short-term cycles now, what has been your churn ratio in your portfolio?
Right, that stays slightly elevated vis-a-vis peers, right? So we are close to a little over 30%. I think the long-only funds would be at say 15, 20% thereabouts. But there is a number we can put to this, right? So let's say you compare us with a fund that has say 100% long-term capital gains. Such a fund doesn't exist. But let's imagine for the purpose of extreme comparison that we are comparing ourselves with a 100% long-term capital gains fund. Let's say in our case, it tends to be 50% short-term versus 50% long-term.
Sure.
That's also another extreme, but let's look at the extent of the extremism that's there in between. At this number, let's say at 50% of the returns, you will pay 15% tax versus 10, right? So you'll pay a 5% higher tax on 50% of your return. So in our case, let's say 22.6, let's say half of that is 11.3, which will be short-term returns. And on that, you will pay 5% higher, which is 55 basis points. Everything else has, so all expenses, STT, etc. is all announced while we calculate the 22.6% CAGR. Now this 55 basis points differential is compared to a 750 basis points alpha since inception that we have generated.
Sure.
Right? So we would like to believe that because of the strategy that we follow, we are able to fully pass this on and sort of take it under the broader umbrella. And the strategy pays for itself, because if it's just buy and hold, my submission to you would be that it won't be able to generate a 750 basis points alpha.